So someone posted this question. I'll let y'all read it for a second right here. And the first piece to your question is, this part is true. People typically scale in because they're not sure of their first entry. They think their first entry is reasonable and they don't want to miss out. So they break their position up, and that allows them to have better risk reward probability, etc. Now, the tricky part about scaling in is most people, they think about scaling in terms of using a wide stop and scaling in. They buy here and they scale in, and the problem is they get out down here and at the worst possible place. And I'm not recommending that. Most people, when they look at scaling in, should think about scaling out of positions first before they scale into positions. So what does that mean? Well, you're long here, you take part off and take another part off, or you buy, take part off at 1 times your risk or 2 times your actual risk and swing the balance. That's how most people should start out when it comes to scaling in. And as far as having a plan and reason for scaling in, you scale in. First off, you have to anticipate scaling in before you take the trade. And the second portion is your reasoning for it is the premise has to be valid. So what does that mean? Well, let's look at an example. This is kind of an easy, let me go to this day. So you had a strong breakout, pullback, strong rally to a new high. This breakout's strong enough that the odds are you're going to get at least second leg up. Therefore, what many traders will do is they will buy small. They know the odds are we'll get a pullback. So what they'll do is they'll say, you know what, I'll buy this low and I'll buy 2 or 3 points lower, or I'll buy a distance, this bar measured move down lower. And then they'll get out back to their first entry. Now, what I would say the first thing to look at is and this goes into scaling into a trend or a pullback. There's no difference in buying here, staying long until up here, or buying this bar and getting out here. It's the same trade. So, in essence, the trader that's scaling in here, they would be willing to hold, if they were swing trading here, they'd be willing to hold through this pullback and use the wide stop. So it's really no different. If you were, it becomes different in a trading range, but as far as a trend goes, if you're just adding on as the market pulls back, you think about it like this. And I don't want to veer too much from your question, but traders buy, the risk gets too big, they lighten their position. However, they want to trade a full-size position again, therefore they will buy pullbacks because the probability is a little bit less, but the risk-reward is better. And you get a breakout again, they tighten their stop, start to go a little bit higher, they reduce their position. Maybe they're buying here, and if they did, they're buying lower, they get out of break even. All in all, the first thing you got to do is understand the overall direction and understand that, can you trade one position and understand that you should be buying here and buying pullbacks. It's not so much the scaling in portion. It changes variables mainly because your risk reward is worse and your probability gets higher. But the main piece that changes is your risk becomes bigger. You're still going to trade. If you see this, you need to sell. And it doesn't matter if you're selling, stop up here, or selling every pullback, or selling every 2 or 3 point pullback, you're selling. So to answer your question, I would say most people scale in when they think their premise is reasonable. However, they're not totally sure. So an example is this bar. This bar's big enough that the odds are you're going to get a second leg. However, a lot of traders would be unsure if the pullback's going to be deep. So they may buy this close, put their stop down here, and maybe they buy halfway. They put a target here, and in this case, didn't get filled. But if they tried to buy 1 or 2 points below here, it would get filled. Other traders, there's many ways. So as far as, yes, people have a premise and they scale in because they're not totally sure. When they are sure, or if it's a, maybe like a wedge bottom here and they're afraid that they may get a bear breakout, or maybe something like this. Higher low here, so you have a new low and a higher low, head and shoulders bottom. Second entry buy, traders may be worried that if we fall below here, it might be a bear breakout of a double bottom and you go for a measured move. Some people would not be willing to buy below this bar, so they may buy a full position here, stop down here, because they want to get out if it falls below this bar. And that has to do with, if it's the higher the probability, then there's a chance that you may get a breakout in the opposite direction. Or if it looks reasonable, a better way to state that is, if it looks the more reasonable it looks, the more committed you'll have, the more traders will be committed, and therefore the more traders will get trapped. Here, this is a good bar, but the context is not as great because it's a strong consecutive bear bar, so you may get a second leg down. So some traders will buy, but want to buy more lower, and they bought more lower, even though it didn't fall below here. So the first thing I would focus on if you're looking to scale in is focus more on probably scaling out of a position more so than scaling into a position, and maybe consider scaling into a winning position before you start scaling into a losing position. It's very dangerous to, kind of like here, if you start buying below bars, you can very quickly take a big loss and get out here, and you end up taking a very big loss. So the one thing, if you're scaling in, you got to think about is risk, reward, and probability. What are you risking, and what is your reward on the trade? If you're risking 20 points to make 4 points, you've really got to do the math and ask yourself, is that practical? And most people screw up with scaling in because while their probability is high, they don't realize that they can't risk what they're risking. In other words, they've got to be really quick to get out, and someone that's buying this low and using a really wide stop and buying more lower, they know when to get out, and they're quick to get out, and that's a very dangerous. To keep it really simple, the math doesn't work if you use the wide stop and you can't get out quick enough. So I'd be very careful about scaling in. So to summarize this video, I would focus on always in and swing trading and seeing if you could possibly scale in with the always in direction. So you're long here. Odds are it'll be, if the pullback's going to fail, so maybe you buy more here, you take part off, and first is going to go down. Maybe you buy more here, bear bar. Maybe you buy more above this bar, tighten your stop down here. Strong breakout. Maybe you scale out of your position. Maybe you get out here. The consecutive buy climaxes, wedge top. So I would think more about scaling in like that in terms of how do I scale in to the always in direction before I start thinking about how do you scale into buying here and scaling in lower, because that's where you can easily get trapped. If you're trading always in and scaling in, you exit when the always in direction changes. So if you're short from this breakout and then you see this, hypothetically, you need to exit shorts. Or if you look down here and you say it's a wedge bottom, leg in a trading range, I don't want to be short down here, you shouldn't scale in. So I hope that helps.